And I'm Mira.
Imagine waking up to, historic peace in the Middle East. You're expecting your portfolio to just soar on the good news, only to watch the stock market absolutely collapse by the closing bell.
It was truly an unprecedented reversal. It really felt like the market woke up celebrating this new era of global stability and then went to bed in an absolute algorithm-driven panic.
Yeah, total whiplash.
Yeah.
So today on this deep dive, we are pulling from a massive stack of real-time market data, central bank pressers, and some pretty intense geopolitical dispatches to figure out exactly how that unraveled.
We've got a lot of ground to cover.
We really do. We're going to quickly unpack the Strait of Hormuz peace deal, some surprisingly hot retail sales data, a very fiery debut from Fed Chair Warsh, and sudden trade threats that basically sent equities off a cliff.
Right, and we'll break down the mechanisms behind all that madness so you understand the baseline you're operating against right now.
Exactly. Just to summarize the pure carnage today, the S&P 500 plunged from a high of 75.32 to close near its low at 74.20.
Ouch.
Yeah, and the Nasdaq collapsed over 550 points to end at 26,021. The VIX spiked to 18.44.
And we saw the 10-year Treasury yield hold firm at 4.463%, while the U.S. dollar pushed up to 100.30.
So, a brutal day all around. But before we get into the actual timeline, we just need to explicitly state that our discussion today is purely for market context and analysis.
Right. It is definitely not personal investment advice or an investment recommendation.
Absolutely not. Okay, let's trace this timeline back to before the opening bell. Session 1, what set the stage before the U.S. session?
Well, the overnight session, it was really defined by what initially looked like the perfect economic scenario. You had this massive geopolitical risk just suddenly removed from the board.
Right. At 5:06 a.m. Eastern Time on Wednesday, June 17th, the headlines hit. President Trump and Iranian officials confirmed an interim agreement to reopen the Strait of Hormuz.
Which is huge.
It is. It means the U.S. is officially lifting its naval blockade. And the details here are pretty fascinating. Iran agreed to dissolve its enriched uranium stockpile.
But we should note they did add a warning that they will charge for maritime services in the strait going forward.
Yeah, a little toll booth caveat there. But even with that, this is a huge headline. Theoretically, resolving a blockade in one of the world's most critical waterways removes a massive stagflationary tail risk.
Because energy shocks act as a consumer tax, right? High oil prices force central banks to keep interest rates high while economic growth slows down. So fixing this choke point is fundamentally disinflationary.
Wait, let me pause you there, Mira. If this peace deal is so incredibly massive, why didn't the market hold its gains? There has to be a catch.
There's always a catch.
Because President Trump also added a rather stark warning. He explicitly said that if a final deal isn't done in 60 days, it is, quote, back to bombing. That doesn't exactly sound like long-term peace to me.
No, it doesn't. And that is exactly why you have to look at this through a game theoretic lens. If you are an algorithm or an institutional investor, you don't price this as permanent peace.
Right.
You price it as classic geopolitical brinkmanship, as bargaining leverage. It's an unstable equilibrium. That 60-day window just puts the global energy market on a ticking clock.
That makes total sense. And just a quick note for you, our listener. When we discuss these highly politically charged actions and statements from President Trump or any global leader, we are impartially reporting the source material to explain market movements.
Exactly. We do not endorse any political viewpoints. We're just explaining the mechanics of the trade.
Right. Our job is to translate the policy into pricing. And speaking of pricing, the energy markets had even more disinflationary news to digest before the U.S. consumer even had their morning coffee.
Yeah, at 4:01 a.m. Eastern Time, the International Energy Agency released a major report warning of a massive 5 million barrel per day structural oil overhang by 2027.
Which is just staggering.
It really is. They are basically saying the world is going to be drowning in oil over the next few years. That long-term glut provides a powerful backdrop that should theoretically keep inflation in check.
And it wasn't just energy getting a reprieve either. Carrying over from Tuesday evening, we had a major development in the tech sector.
Oh, right, the blacklist news.
Yeah, around 8 p.m. Eastern Time on Tuesday, news broke that the U.S. delayed adding over 100 Chinese tech firms, including major players like DeepSeek and CXMT, to a national security blacklist.
This is a massive breather for the global AI supply chain. When you combine an interim peace deal in the Middle East, the IEA projecting a massive oil glut, and a sudden pause in the U.S.-China tech war.
It's the perfect setup.
Exactly. The overnight session really teed up a flawless risk-on morning. It looked like smooth sailing.
But that entire optimistic narrative violently unraveled the second the U.S. data hit. So we're going to take a very quick break, and when we come back, we'll dive into exactly what triggered the collapse.
Stay with us.
All right, we're back. The table was perfectly set for a rally, but then reality hit. Session 2. What moved markets during U.S. trading hours?
This is where the structural reality of the U.S. economy completely collided with the overnight optimism.
So if you're looking at your portfolio on Wednesday morning, you're expecting green screens. Then at 8:30 a.m. Eastern Time, the May retail sales data drops, and it completely shattered expectations.
It really blew past them.
Core sales rose 0.8%. Headline sales gained 0.9%, and year-over-year retail sales surged by an incredible 6.88%.
Which sounds like great news for the economy, but it is terrible news for the stock market.
Hold on, let me play devil's advocate here for a second. Why is the consumer spending nearly 7% more than last year a bad thing? Doesn't robust spending mean the economy is strong?
It does mean the economy is strong, but it feeds directly into the central bank stagflation trap.
How so?
Well, think about the mechanics. When consumers are spending at that high of a clip, corporations have total pricing power. They don't need to offer discounts to move inventory.
Right, people are buying anyway.
Exactly. And when corporations maintain pricing power, we see inflation as a self-fulfilling spiral. It remains incredibly sticky. The economy simply isn't cooling down the way the Federal Reserve needs it to.
So any hope that the Fed could look at the Hormuz peace deal, assume energy prices will fall, and say, great, let's cut interest rates. That just went right out the window.
Completely out the window. The retail data prove that the domestic economy is still running way too hot to justify rate cuts. Which brings us to the main event at 2:46 p.m. Eastern Time.
The highly anticipated press conference from Fed Chair Warsh.
Yes.
And what a fiery debut it was. I mean, he did not mince words. Warsh stated point blank that the Fed is determined to fix its 5-year miss on their inflation target.
He was incredibly hawkish.
He was. But the detail that really made my jaw drop was his transparency about what was happening behind closed doors. He revealed there was a 50-50 split committee on whether rates should be higher or lower right now.
Yeah, he actually called it a good family fight.
That level of transparency is wild, and it completely spooked the market. By revealing that half the committee actively wanted higher rates, he crushed any lingering hopes for near-term cuts.
We saw the immediate effect of discount rates as financial gravity pulling down the broader equity market.
Let's unpack that analogy for a second. When we say discount rates as financial gravity, what we mean is that when the risk-free interest rate stays elevated for longer than investors expected, that high rate acts like a heavier gravitational pull on stocks.
Right. It doesn't matter how fast a company's growing, really. That heavy gravity compresses the multiples investors are willing to pay for future earnings.
Precisely. And that sudden realization that rates aren't coming to the rescue caused a violent repricing across the board.
It was brutal.
But I have to push back on the timeline here a bit. Warsh was hawkish, yes, but he spoke at 2:46. The truly catastrophic collapse in the Nasdaq happened a bit later.
That's true.
Was it really just the Fed, or did something else trigger the algorithms? Because at 3:13 p.m. Eastern Time, President Trump suddenly threatened to immediately terminate the USMCA trade agreement.
Right. He stated he, quote, would rather leave it unsigned.
Exactly. So was it the Fed's gravity, or did the massive algorithm-driven sell-off truly accelerate because the USMCA threat hit the wires? I mean, the implications for North American supply chains are catastrophic if that trade pact just disappears.
It's the compounding effect. Neither event would have been this devastating in isolation. Warsh set the kindling by confirming the Fed isn't lowering rates to save valuations.
Okay.
But the USMCA threat was the match that lit the fire. Trading algorithms are programmed to scan for supply chain disruptions. Terminating the USMCA means instant, severe tariffs and absolute chaos for the auto and manufacturing sectors. So you had a market priced for absolute perfection suddenly facing a hawkish Fed and unexpected severe trade headwinds at the exact same moment.
It was a brutal 1-2 punch that knocked the wind out of the entire market. Let's take a quick breather here. When we come back, we'll look at the specific corporate fallout and what you need to watch next.
See you in a minute.
We are back. The dust has settled and the damage is done. Session 3. Corporate events recap and what to watch next.
Let's start with the energy sector because it perfectly illustrates the tension between geopolitical headlines and physical reality today.
Right. Despite the peace deal in the Middle East and despite reports at 1:14 p.m. Eastern Time that Iraq jumped its southern oil output by 500,000 barrels per day, the energy sector ETF, ticker XLE, closed down 1.25%.
And WTI crude fell to $75.20.
But underneath those falling prices, there is a physical reality that is keeping a floor on the market. U.S. Cushing inventories just plunged to operational lows of around 20 million barrels.
Which is the lowest level we have seen since October 2014.
So, if I have this right, we are seeing markets pricing ahead of physical reality. The algorithms trade the oversupply headline from the IEA and the peace headline from the Strait of Hormuz, driving paper prices down.
Yes.
But the physical buyers looking at the actual storage tanks in Oklahoma realize they are nearly empty.
Exactly. The paper market is trading tomorrow's promises, while the physical market is dealing with today's scarcity.
Now, shifting gears to the mega cap tech bloodbath. To understand today's drop, we have to briefly reference the massive carryover context from the prior session.
Right, Tuesday's action.
Yeah, on Tuesday evening, we saw SpaceX surge to a $412 billion valuation, and NVIDIA filed for a massive $25 billion debt offering.
And we use those examples strictly as background to explain a crucial concept, mega capex as a market fragility mask. Right now, the broader stock market is entirely reliant on these massive tech monopolies executing their capital expenditures flawlessly. They are the only pillar holding up the major indices.
And because they are the only pillar, when discount rates rose today after Warsh's presser, the tech sell-off was absolutely agonizing. The tech ETF XLK dropped down to 185.80.
When the foundation of the market is that narrow, resting entirely on a few AI giants, any tremor in interest rates feels like a massive earthquake.
Which brings us to our closing bell joke for the day. You know, the Hormuz deal was supposed to be a step toward peace, but it basically caused total war on the Nasdaq.
Yeah, no kidding.
Warsh's good family fight left everyone's portfolios totally miserable. And if the USMCA is actually terminated, we won't even be able to afford the imported Canadian liquor we need to cope with the losses. It looks like the Fed's higher for longer stance applies to our blood pressure, too.
I think everyone's blood pressure spiked watching the tape into the close today.
Truly. So looking ahead, what do we need to watch next? On Thursday morning at 8:30 a.m. Eastern Time, we get weekly initial jobless claims and the Philly Fed Manufacturing Index.
We also have the Bank of England rate decision on Thursday, which always has the potential for spillover effects into global risk assets.
And crucially, for Thursday's close, remember that triple witching options expiration has been pulled forward to Thursday.
Oh, right, because U.S. markets are closed on Friday, June 19th for the Juneteenth holiday.
Exactly. And for those who might not know, triple witching is when stock options, stock index options, and index futures all expire on the same day.
Because it's being pulled forward a day early, you should expect massive, erratic volatility heading into Thursday's close, as institutional traders are forced to roll over or close out all those contracts